In this week's recording, we're going to look at the in-class example, which is focused on looking at a calculation comparison of the three main accounting measurement methods. So we finished off a historical cost accounting in the week 2 lecture, and we're going to look at a practical example here. What would the historical cost accounts in terms of statement of comprehensive income and the statement of financial position look like under historical cost accounting? The rest of the recording then is going to focus on this thing called the current purchase power accounting. And we're going to look then at the numerical example and how the accounts would differ under that perspective. So remember now, historical cost accounting, its main assumption is maintain financial capital. It ignores general price movements, i.e. inflation, and it ignores the current market value of any asset. So what we're told in this example is a company commenced trading in 2010 with €3,000 capital. It acquired 6 items in inventory, so it spent all its capital, €500 each, but only sold 3 of them. So 50% of inventory was still there at the month end. And they sold them for €900 per item. So the sales for the period will be 3 items, half of them at 900, which is 2,700, and all transactions are on a cash basis. The general index we don't need for historical cost accounting, because remember, it ignores inflation, and we don't need the replacement cost, because again, remember, the historical cost accounting does not use the current market value of the asset. So the historical cost accounts will look something like this. So we'll put it here, we'll call it HCA, and we're going to look then at sales, cost of sales, and gross profit. So we'll figure out our cost of sales. Actually, I'll need to leave a few lines. So your sales here are going to be 2,700. And that's coming from you sold 3 units at 900 each. So that should be straightforward based on the information of the question. Your cost of sales is made up of opening stock, purchases, and closing stock. Opening stock, there is none, because you started this business at the start of the year. You purchased €3,000 worth of goods, 6 units at 500 each. And your closing stock is going to be 1,500. Now remember, in historical cost accounting, we measure closing stock at its historical cost. So what you bought it for, you measure at the 500. So your cost of sales then are going to be 3,000 or 1,500, and your profit is 1,200. So that's your profit. We call it gross profit. We just call it profit because there's no expenses here. So your profit under historical cost accounting for the year is €1,200, and that's using the historical cost of 500. We don't worry about here the general price index, and we don't worry about the replacement cost, because that's not how historical cost accounting works. So that's your statement of profit and loss, or otherwise known as the statement of comprehensive income. Your statement of financial position, SOFP, as at 31st of January 2010. You're going to have your no non-current assets. You have inventory, which is a current asset. Inventory is measured at 1,500. Right? Because remember, we're measuring it at historical cost. So it's the 3 units at the 500, and you have cash of 2,700. So you have total assets here of 4,200. So remember that here now, that you've sold the sales for cash, so it must be in cash at the year end. You started off with cash of 3,000. You bought inventory worth 3,000, which brought your cash to nil, and then it brings it back up to 2,700 when your sales. Your capital was always 3,000. That was your starting point, how much you put in, and your profit for the year will look 1,200. So your total equity and liabilities, in this case your total capital, is 4,200. And that is how your statement of financial position balances. So it's a very crude, very basic statement of financial position. We're getting across, and we're going to look at the differences. In this instance, historical cost accounting has a profit that's going to be distributed of 1,200. 1,200 profit is 1,200 profit that can be, and what we call those here, if you want to use it, is it's called distributable reserves. That's what it's called, distributable reserves. What we mean by that is that can be paid out. It can be distributed as profit. Now, that's the core one. That shouldn't have caused students too much hassle, but it's important to practice that because you need to know your calculations as well. All right, not just to be able to talk about conceptually how each of the methods work. So now that we've finished with historical cost accounting, we're going to look at the main purpose of this recording is current purchase power accounting. Now remember, the difference here is the focus of current purchase power accounting is to maintain the purchasing power of your capital. So whereas historical cost accounting maintained the financial capital, it ignored it ignored inflation, i.e. the price increases. What current purchase power accounting does is it looks at adjusting historical cost accounts for changes in purchasing power, and they use a price index. So their example, if you didn't adjust profits, you will essentially over distribute profits. You will overpay dividends, and that will essentially reduce the operating capacity. And we've seen that in previous examples with the land, and in our live session was if you use historical cost accounting, you overstate profits, then you overpay dividends, you actually erode the capital of the business and you erode the operating capacity. What current purchase power accounting does is it uses a generic inflation index. And generally what we use is called the CPI, the Consumer Price Index. And you can find this if you want to, for example, you can even go on to Google it. So the Consumer Price Index Ireland. So the CSO, the Central Statistics Office, do this. And generally they take a basket of goods, a general basket of goods, and they track the price in it each month. So you can see generally inflation, it's actually been deflation because it's stated where the economy is. But if you go back long enough, there can be general inflation. It can be 1-2%. And generally what, you can see the annual change if you want to have a look at it here over a number of years. So you can see across all of the years where it is. But it generally doesn't go over about 2 or 3%. Usually the central banks try and keep it at a manageable level to keep the economy in check. So the key thing about the current purchase power accounting is it doesn't adjust every individual asset or individual line item for its own special inflation. It uses one general price index. And all of the adjustments are performed on the historical cost accounts. So that means we take the historical cost financial statements and we adjust those. One important distinction that you need to get your head around now is monetary and non-monetary items, right? They're considered separately. The value of monetary items does not change because, of course, remember, cash is cash. So monetary items would be cash, loans, trade receivables, trade payables, because they don't change. If you have €1,000 at the bank in January, you still have €1,000, right? What will change is its purchasing power. So that's when we look at the value of non-monetary assets do change, i.e. the purchasing power in terms of land, property, plant and equipment, inventory. So it's an important distinction when we're looking at those. So non-monetary items would be everything else, all right? And same with liabilities. So anything that's monetary, the likes of loans and overdraft or trade payables, they are not adjusted because they are as they are. They stay with the actual physical amount of money, but what happens is the value of that money in terms of its purchasing power will change. And that'll become clear when we go through an example to understand. All right? So monetary items, they are subject to a gain or loss because as inflation goes up, we'll be losing purchasing power. And this is an important distinction you want to understand, purchasing power gains or losses are included in income for the period. Right, that's quite important. And if we go back to the little example that I used last week, just to bring it in here to show you. Remember I told you I had €1,000 and that could buy 10 games at €100 each. And then I said a year or two later you still have the same €1,000, but now you can only buy 8 games at 125 each. Right, so does everyone see that? So essentially what's happened here is you've lost purchasing power. That €1,000 that could buy you 10 games can now only buy you 8 games. So what we do in current purchase power accounting is we quantify, it's still the same amount of money. That's why we don't change it in the financial statements. The €1,000 in the bank account That period, still the same €1,000 here. The only difference is it's lost purchasing power. And in current purchase power accounting, we give you a method to quantify how much purchasing power has it lost. And we put that actually in the financial statements. We reduce income. So that means less income, less distributable profits. There is no change in purchasing power from holding non-monetary assets. So if I hold inventory or I hold property, plant and equipment, the value of that asset will go up as inflation goes up. So I don't lose money because I can just sell it on. So we just adjust them to keep them accurate in the financial statements. So there's a fundamental difference there between monetary items, which are not adjusted for, but we do calculate a profit or loss on purchasing power, and non-monetary items which are adjusted for. So it's fundamentally different than how we did current cost accounting, historical cost accounting. So the steps, the first one is calculate the gain or loss of holding monetary items, and you include that in the income statement. You then do the income statement and you restate revenue and expenses. So all those items that we had in here as historical cost, they have to be restated based on the price indices, the general price index where it goes. So there's a bit of work there. There are adjustments involved. And then you restate the statement of financial position. Right, so there is a good lot of work to do there. And we're going to go through that step by step for the in-class example. And then you're going to do a number of questions in the question pack as well. We'll finish off a small bit of the theory here first. So the basis here is monetary items are subject to a gain or loss as price levels go up. And it's important to think about this. In times of inflation, so by inflation we mean prices are increasing, monetary assets lose value. And this is the example we've seen here. When prices of the games go up, the asset, the cash that I had in my bank account, it lost value because I could buy less games. But monetary liabilities gain. So if I had debt of €1,000 at the start and all prices in the economy and incomes are going up, I still have €1,000 debt at the end. It's less in real terms. So often what you will hear about economies inflating their way out of debt, that's what they mean. If assets have one impact, liability is the opposite. And of course, if you have deflation, where prices are going down, it's the opposite impact. Monetary assets lose value, monetary liabilities gain value. All right? And these purchasing power gain or losses are included in income. All right? The income statement is restated and the statement of financial position is restated. And that's where we're going to start now. Is we're going to say, look, we've talked about it. Conceptually, we understand we're adjusting historical cost accounts with a general price index. But now we're going to get into the nitty-gritty of, well, how does it actually reflect then? How do we show this in the in-class example that we had? So current purchase power accounting, number 2, this is on the basis of maintaining purchasing power. That's the basis of current purchase power accounting. We're going to use the same examples here because essentially, remember, we're using the historical cost accounting as the baseline. But what we're now going to do is we're going to use the general price index. It started off at 100 on the 1st of January. It went up by 12% up to 112 in the middle of January and up to 130 at the end of January. Now these are artificial ones, but they are giving you a good example of how you might use the index no matter what the numbers are. So your starting point, the first step in the question, is calculate the gain or loss on holding monetary items. Well, we know the monetary item we had at the end of the period was 2,700. So if I do it down here, that's your historical cost accounting. So I'll come down here and I'll do the working for working 1. Monetary asset at the 31st of the 1st, 2010 was 2,700. Remember, on the 1st of January, we had 3,000 and we spent it straight away. So we didn't have any actual cash until the cash we had at the end, 2,700, right? We received that cash on the 15th of January. That's when we made the sale, when sale made, all right? On the 15th of January. So what we have to do is we have to figure out, did it lose or gain purchasing power over that period? What was the purchasing power loss as prices went up over that period. That's what we're asking ourselves. So remember, the index on the 15th of the 1st was 112, and the index on the 31st of the 1st was 130. So this is important. So we only are interested when we get the cash in. We got the cash in on the 15th of January, and it was worth 27. However, prices have gone up since then over the last 16 days. Right? So what we're saying is the new cost of assets worth 27 on the 15th of the 1st is now 27 times 130 over 112. So you're saying if I had an asset on the 15th of January, I could have bought it for 27. But now in the intervening period, prices have gone up. So now that asset that would have cost 27 would now cost 3134. My cash stays the same. It's still worth 27. So that means I am short 434. That is a monetary loss, or loss in purchasing power. Let's call that a loss in purchasing power. Because we maintain the same cash flows, the 27, even though the price of assets in general are going up, it means we're losing out. And we have 434 less in purchasing power than we did 16 days ago. Now that is conceptually tricky, but it's all about practice here. The more you practice with this, the more comfortable you become. And there are going to be questions in the question pack that's going to help you along as well. So bear that in mind. We're going to come back to that in a second. We're going to put that down in our income statement. But for now, we're going to leave it there and we're going to come to it when we need it. We then go back to our statement. We take our statement of profit and loss. We'll put it here. I'm going to call this CPPA. And we're going to look at what our P&L is going to look like. The sales, you need to adjust. They're now the historical cost sales, 27, times 130 over 112. And that is your 3134. Now, why am I doing that? I'm saying that sale was made on the 15th of January when the general inflation index was 112. We need to bring everything to the end of the period, so those sales now would have been at 130. So you divide by the 112 and you multiply by the 130 to bring it up to its true purchasing price. You're adjusting for inflation. Opening stock, we had none. Purchasing, be careful. It is going to be 3,000, the historical cost of the inventory. You multiply by the 130 and you divide by the index when it was there. So the index was there at 100 because you purchased it at the 1st of January. So the actual purchases now are 39. That's an important one. And same with the closing inventory. It's going to be half that because you have 3 assets left in inventory times 130 over 100. So that, if I put it here, 1500 times 130 over 100. $1950, and that's of course going to be a minus because you're taking off closing inventory. So your closing or cost of sales is 1950 and your profit is 1184. That's usually where we'd stop, but the tricky thing here is you must put in the monetary loss, the minus 434 we had from working one. So the actual profit here is 750. That's the profit under current purchase power accounting. So you take that monetary loss from holding monetary assets, the 434. We didn't have any other monetary item. It was just cash. And we put that into the income statement. That's fundamentally different than how you do historical cost accounting. We still have to see now the statement of financial position, how it's going to balance. But in this instance, you have your 750. That's the profit that we're going to look at in terms of being distributable. Statement of financial position then, we are going to balance it up. We put in the statement of financial position, 31st January 2010. The inventory is going to be measured at the closing inventory here. They have to be the same. Whatever you measure the closing inventory in the P&L must be the same as the statement of financial position. Your cash does not change. Does not change because it's monetary. Remember we said that before. Monetary, it's still going to be 27 regardless, because no matter where inflation goes, because that's money in the bank account. So your total assets then are 4650. Different because we said the assets were understated at historical cost. They must be brought up based on inflation. Your capital also changes. It's 3 million. That was invested in January. So it's times 130 over 100. So it's 39. So you bring it up when the transaction happened, and you bring it up to the end of the period that you're looking at. And our distributable profits here now are the 750, not the 1184. And when we tot those up, our capital, or total equity if you wanted to call it, 4650, matches your total assets. But what we notice here now is we can distribute a lot less. Distributable profits here, or distributable reserves, are only 750 compared to 1200 when it was looking at historical cost accounting. That is because your profits were overstated and your assets were understated. Now, this is a simple example, but again, it just shows you that when you get to a broader, bigger set of financial statements, and this is quite important, and it can change how you look at your profits and the impact on dividends as well. All right, so just bear with it. You don't need to worry about the last one for now. Just focus on the first two, historical cost accounting and current purchase power accounting, and make sure you're happy with those. We will look at the current cost accounting, the last one, on next Monday, week 3's session. All right. So finishing off then current purchase power accounting, the advantages, right? It's relatively simple and inexpensive because you don't have to collect data about replacement costs. You only need a general price index. All right. And relative to cost accounting, it reduces the possibility of overpaying dividends. So it does have benefits, right? You only use it takes a kind of a simplification. It only uses one general price index, and it avoids you overstating your profits and therefore overpaying dividends. The disadvantage is it's only one price index as well. So it's a very simplistic assumption. Because remember, the inflation rate for revenue could be different than the inflation rate for inventory, different than the inflation rate for costs. So realistically, you should be looking at an inflation rate for each one, which is what the next method does, current cost accounting. So it's subjective. And oftentimes the adjusted values show little correspondence with their actual values. And that's what we can see here. We can see here the replacement cost of inventory per item at the end of the year is 700. So 3 of those items that are inventory are actually the replacement cost is 2,100, 3 times 7. Whereas what we've put in the current purchase power accounting is 1,950 because we've just used a generic price index which won't necessarily match exactly each of the movements in the asset values. So it's a simplistic assumption to make it easier, but of course it comes with its limitations as well. So you need to know the pros and cons and how to do a calculation as well. All right. So this short recording looked at number 1, numerical example of how to do historical cost accounting. It introduced the concept of current purchase power accounting, which is focused on maintaining the purchasing power in a business. And it also then looked at the numerical example of how to go about that. Right, so you need to have that covered, and again start to look then at your question pack 2, which looks at accounting measurement, and we'll finish off this session then next Monday at week 3. Thank you very much.